Hey everyone, welcome back to another installment of Things You Should Know Accounting Edition. Today we're going to cover 3 more examples of business transactions, and my goal is to use Jello's Coffee Shop for the time being for all equation and examples. This is just so you feel like you have a friend in Jello. So as a reminder, assets will always equal the total of liabilities and owner's equity. This equation is key to everything. This is the idea behind double entry bookkeeping, which I will cover at a later time on a later video. But for now, suffice to say that all entries are recorded in terms of debits and credits. Since a debit in one account will be offset by credit in another, the sum of all debits must therefore be exactly equal to the sum of all credits. For layman's terms, this means that for every transaction, there should be 2 entries in order to make the equation equal on both sides. The debit either increases the assets or decreases the liabilities and equity, while a credit does the exact opposite. It will decrease an asset or increase a liability in owner's equity. So the first transaction today, we're going to cover revenues. It's a new type of equity in the equation. Remember, each of these things, the assets and liabilities and owner's equity, can have many smaller buckets in it that record each type of service, each type of asset, etc., etc. Revenues, the new equity, it's going to be a new equity item, are recording the money made by the coffee shop by selling goods and performing services. So for the first month, Jello did extremely well. He earned $35,000 in selling coffee that month. In addition, he earned $10,000 more from the Boys and Girls Club for performing a fundraiser. However, the Boys and Girls Club couldn't pay him up front, so they owe him and they agreed to pay him within 30 days. So let's go to the first part of the transaction, guys. You received $35,000 in cash. So you'd put that in cash, of course, and it would increase it from $90,000 to $125,000. That's always good to see for a business owner. To offset that, you got to record on this side, and that would be in your revenue. Revenue records money earned for services performed or goods sold. So $35,000 there, we add $35,000 to revenue. They balance out. We're good to go. Then for the fundraiser, you actually haven't received the cash. You've earned the cash but not received it. This means we should track it separately. Since we got no cash, we still have an asset. They owe us money. So we'll start a new account, a new type of account, accounts receivable. Now, a lot of times this is shortened to AR. That's the abbreviation for it. But for now, we'll keep it fully written out. Accounts receivable is money owed by the customers, individual or corporations, to another entity in exchange for goods or services that have been delivered or used but not yet paid for. Receivables usually come in the form of operating lines of credit and are usually due within a relatively short time period, ranging from a few days to a year. And that is from Investopedia.com, guys, that definition. Thank you, Investopedia. So what do? You form a brand new account. You put that $10,000 in. That's what you're owed. You have to offset it once again. You've earned $10,000. You may not have received it, but you've earned it. So you'll add that $10,000 to your revenue. So by the end of the month, you add all your revenue together. And so this month, you earned $45,000 in revenue. And you're going to keep track of this over the course of the whole year. So this will be a running tally as you go. In the end, you end up with $162,000 in assets. And when you combine all these, it's $162,000 in liabilities and owner's equity. All right, guys, we're going to talk about a second transaction now. Today, expenditures. Expenses are the opposite of revenues. Examples of expenses include payments to suppliers, employee wages, factory leases, and depreciation. Once again, thank you, Investopedia.com, for that definition. If you look at the total, Jello needs to pay $2,000 for that month's rent, not bad rent, $3,000 for employee wages, and $1,000 for utilities. So it's a total of $6,000 in expenses. The first thing you want to do is mark where those expenses go in the equity. So you'd subtract $2,000 for rent, $3,000 for wages, and $1,000 for utilities. To offset that, to pay for that, because this is outflow, you go to cash. You have to spend $6,000 in cash. So you subtract $6,000 in cash. This drops you from $125,000 to $119,000, and this will drop your liabilities and equity by $6,000 as well. In the end, your total assets equals $156,000, and your total liability and owner's equity is $156 as well. Once again, We're just concerned with making sure we equal the equation. The equation has to be equal. So we spend out expenditures would result in a less cash in our pockets. Okay, guys, the final transaction today is an owner withdrawal of equity. So Jello's a bit tight financially. He needs a bit of extra cash. He has spent a ton of his finances on this new place, hasn't been able to work his old job, so he's got to pull some money out to live on. Not as an employee, though, just because he wants some extra money. So this is how you'd handle it. Jello will reduce his cash by $10,000. This represents money taken out of the bank account. So once again, we will credit cash $10,000. It'll drop it to $109,000 in the bank. Now, to offset it, it's not a business expense. He's not doing this to pay for something for the business or to even pay himself something he calls a salary. This is just extra money he wants out of the till. He doesn't really care. So it wouldn't go in any of the expenditures. These have to be business related. So the only place it really leaves him is owner's equity, which is the money he put into it. So when we look at that, you subtract $10,000 out of owner's equity, that is a debit. You subtract $10,000 out of cash, that is a credit. They equal out. It leaves you with $146,000 left in assets and $146,000 in liabilities and owner's equity. So guys, we have covered 3 more transaction types. It's all very general. Don't worry about keeping up too badly. We're going to go over in more detail. This is very generalized detail. You'll get more background on things. Don't feel like you're missing stuff. Next time, we'll go over the financial statements for the Jello coffee shop. Now, financial statements are a way for investors to look at the business to determine if it's worth investing in, or debt holders like banks. The bank wants to see how you're doing, or state regulators or federal regulators. They want to see how much they need to pay you in taxes. Those 3 types of statements will be covered as the balance sheet, the statement of owner's equity, and the income statement. And like I said, these 3 statements give a clear and concise view of the financial condition of the company. Well, until next week, I'll talk to you guys later. Take care.